Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on another new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Tuesday morning. Yesterday was down on the Nifty, but broader markets did just fine. And I think that's a backdrop. There's not very much new earth-shaking information from global markets, but there is some stuff which we will address right here in the next 5 or 6 minutes or so. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, morning.
Hi, morning, folks. And, when it's tariffs, nothing is earth-shaking anymore, right? All those, what was that? The marginal diminishing utility sort of principle. Yeah. That's what it's become because the market just completely brushes aside all tariff talk. But that's kind of time we're in.
Well, indeed, there's uncertainty in the air, but, it seems that some of this tariff news will have to be bigger to make a bigger impact, I think. So, and I'm still smarting yesterday, after yesterday's loss. I thought India almost got there. We fought back well, but difficult times. Boys will fight back.
22 runs, just there, almost there.
Almost there.
Well, let's talk about, markets then, right? Maybe better luck here. Last 2 days, though, markets have been down. Friday, we saw a crack. Yesterday, the market was down on the Nifty. But as I said, how would you characterize yesterday's day? Pretty okay, because the index was down, but broader markets were okay. I'll get to that in just a bit. So we'll start it from take it from the top. You've got S&P up, NASDAQ up, Russell up. So you've got US equity markets, which are flashing green this morning. And part of the reason, actually, US markets started slightly lower. But then President Trump essentially made some comments signaling openness for further trade talks with the EU. This, of course, the weekend comments of 30% tariffs on EU, etc. Even then, the euro, the dollar, etc., had not reacted big, and market interpretation has been that, well, there'll be negotiation or it'll be pushed out. The August 1st deadline will itself be pushed out. And of course, President Trump has signaled openness, which went well with what markets did. Dollar index up a little bit. The yields, 2 basis point change, nothing really. Dollar above 98, the broader dollar that is. Brent oil prices have been bouncing around. 70, 68, 70, 68. So we're back at about 60, just under in that range once again. Now, the other, and many use this as a proxy for, animal spirits in stock markets, in financial markets, risk markets broadly. Crypto, Bitcoin, of course, is the poster child there. Hit $123,000. Focus, new high, basically. Focus on crypto week in the U.S. House of Representatives. And, what markets are watching, the crypto markets are watching, is U.S. lawmakers considering crucial crypto legislation. It's a complete 360-degree turn for many around the world because U.S. is now kind of trying to, under the Trump administration, mainstreaming crypto. Crypto is okay. Crypto is well. You must have crypto in your portfolio. That seems to be the message. And we'll see. We'll track this one. But there is, of course, specifically with crypto, positive news. But I think generally there's an indicator, broader market and the risk environment, which is quite upbeat. Now, Trump, of course, also, there was that news flow expected on Russia. Trump is threatening to impose secondary tariffs of 100% on Russia. He's also pledging additional U.S. military support for Ukraine. The word used was top-of-the-line military hardware potential sales to Ukraine. Now, this is, again, a complete 360-degree turn from, President Trump's stance on Russia. It was about stopping the war, but then it's not really worked out. So we'll see how this goes because, if the U.S. commits itself to supporting Ukraine, you're essentially looking at this 3-year war elongating a lot more. Now, I'll come to the market here straight up. So IT was the problem child, TCS, Infosys, etc. Actually, Wipro, HCL Tech, and we'll talk more about numbers which came after market hours. So the Nifty was down because of that, but the rest of the market actually was quite buoyant. Mid-cap index was up, small-cap index was up, Nifty Bank was absolutely flat. The Nifty tested it broke for the 20-day on Friday. It yesterday broke the 40-day and then showed some bounce. It tested the 40-day exponential and then showed some bounce. We need a daily positive close for the Nifty. If the 40-day exponential, the market stays under it, then you're looking at 24,940 as the next level. which is nothing but the 61.8% retracement of the recent move. Resistance, two numbers. The 20 hourly stands at 25,170, and then the 40 hourly exponential average, which is 25,275. Very near-term levels here, but that's what we're working with. If you're trading, Bank Nifty, once again, like Friday, held the 20-day moving average, 56,732, and then ended flat. We need one more day of defense of the 20-day moving average. We'll see if that happens today or not. Downside level, if that goes, is for the Nifty Bank is 56,130 or so. GIFT Nifty will give you a quick sense of how we're likely to start before we go any further. Once again, absolutely flat this morning. Surabhi.
Like I was saying, nothing is moving the market. At least the tariff talk certainly isn't. Asian markets are also fairly mixed, but they're not flat entirely, because if you're looking at the Hong Kong market, for instance, it's up about 0.5%, but the mainland Chinese market is down 0.5%. Japan is completely flat. There's lots of news to digest. And by the way, there's some very interesting news that's just breaking right now on, on the screens. NVIDIA will be allowed to start its chip sales to China. Their chip sales that were blocked in April. The company's just issued a statement saying the US government is going to be granting it the licenses once again. So that's perhaps going to be playing out in the US market action later tonight when it comes back on stream. But anyway, out of China, there's plenty of data this morning, and the data is not too bad, frankly. The GDP number at 5.2% is ahead of estimates. The industrial output number for the month of June, 6.8%, again ahead of estimates. But the dark side or the underbelly is the retail sales number, consumption growth. That slowed down in the month of June. So retail sales at 4.8% in June versus 6.4% in May. And overall fixed asset investment growth has also been very muted this year for China. First half, it's up just 2.8%, which is lower than estimates. Apart from this NVIDIA news that's just hit the wires, the other thing that Wall Street is going to focus on is all the key bank earnings. And it's a very heavy 2 days. Today, Citigroup, JP Morgan, Wells Fargo. Tomorrow, it's Morgan Stanley, Goldman Sachs. And I think Bank of America is coming out tomorrow. So that's what the market focus is going to be on. Clearly, tariff headlines is basically not something that the market is looking at too much. But having said that, now, from an Indian perspective, this chatter about 100% secondary tariffs on countries that are buying anything from Russia, this could complicate the situation once again for India. Because remember, there's the additional 10% BRICS tariff, and now Mr. Trump is talking about 100% secondary tariffs if you're buying anything from Russia. And now all of this is happening against the backdrop of India still trying very hard to get that bilateral trade agreement, some shape or form of that trade agreement in place. In fact, the Commerce Ministry team is again in Washington. They'll continue these conversations for 4 more days. I think the talks wrap up on Thursday. So that continues to be a key watch point as well. Now, for us, the big macro cheer is inflation. The CPI number that came in yesterday continued to show more softness from the previous month. So for June, inflation, consumer inflation is at just 2.1%, slightly lower than estimates as well. And food inflation continues to fall further, which is the good news. In fact, there's disinflation when it came to food this time around, minus 1.06%. So the inflation picture has been looking good. On earnings, HCL Tech, well, it's a mixed bag. I think the market will really focus on this cut in the margin guidance and what the company is saying. The revenue is also down. It's fallen 0.8%, a little less than what the street was fearing. But the margin issue, the fact that the margin itself in this quarter is down 100 basis points, plus the cut in the guidance, that's going to be a key watch point. Speaking of more stocks, M&M will definitely be on the radar because Tesla is rolling into India. The launch event is slated right here in Mumbai, BKC, and we'll get you the latest. So watch for, some chatter if there's some, change in trading positions around Mahindra and Mahindra as well. Finally, to cap it off with the flows picture, we're very range-bound. It's just time consolidation that continues in the market. And the flows, at least yesterday, were more or less offsetting each other. 1,800 crores of DII buying, 1,600 crores of FPI selling. So net-net, we had another flat session. Nigel, over to you.
Well, yesterday's trading session, a bit of an intraday dip on the Nifty got bought into. We ended with a cut, but not as deep as what it was at the low point of the day. However, there were a couple of positives because the small cap index, in fact, that put on close to 100%, telling you that there was select buying in the broader markets and telling you that the domestic money as well is still quite buoyant about the trajectory of the markets. Well, and the VIX continues to remain at very, very low levels. Given that we have fallen from around the 26,000 mark closer to 25,000, the VIX is not still suggesting any kind of fear in the system. And also another point is that the Nifty RSI that had moved to around 70, 72 odd, that's cooled down to around 47. That's the lowest that we have seen in the last 3 months or so. Let's get into what the FIs did in yesterday's trading session. Well, they added shorts. The short positions are the highest that we've seen all the way since March earlier this year. They wrote more calls than puts as well. So we have a fair bit of short positions in the system. But let's talk about the FI as well as the client positioning as of now. And the clients, they continue to add the long positions. So from around 40,000 contracts, now it's at around 80,000 contracts. So clearly they've added quite a bit of longs on that side. The FI shorts, well, that's reached the highest level since March 2025, and that's at around 1.2 lakh contracts. So we've got a fair bit of shorts in the system. In percentage terms, it's at around that 82% odd mark. So there are shorts in the system, sometimes a little dangerous, to wish for something. We wanted some shorts. Now you've got shorts loaded into the system. But I'll tell you what, if we can get any kind of positive news, these shorts will be forced to cover out. And as we have seen in the past, at around this 1,20,000 contracts odd, we sometimes see a bit of a short covering bounce that does play out. Moving to the options data, then, you had a fair bit of call writing in yesterday's trading session. And because of that, the PCR has come down to the lower end of the band. Remember, a few trading sessions ago, it was at around 1.2. Now it's come down to around 0.72 or thereabouts. And the 25,100 call, fair bit of open interest built up out there. 25,050 put as well. So both those two are very, very active. And that perfectly ties in with the key levels that we're looking at. So on the upside, the 20 DMA becomes a near-term resistance mark, which comes in at around the 25,272 odd. And support comes in a little south of the 25,000 mark. That's the near-term band, very, very crisp. A break of either which of these levels will give another 200-300 points in that direction. So we'll keep an eye out on this. The Nifty Bank as well. Well, yesterday from the lows of the day, it did see some buying, and that was doing a relative outperformance. But the Nifty, that's going to be important because on a day-to-day basis, it's making lower highs and lower lows. For today's trading session, you'll want it first to make a higher high. Let's get past this 25,150 mark, and you'll want it to protect the lower level. So I'll keep an eye out on that mark of 25,150. The Nifty Bank, as I said, did a relative outperformance yesterday. It's still protecting lower levels of 20 as well as the 50 DMA. It'll have to lead the way because the tech space could be under some pressure. And finally, the word on Mahindra & Mahindra. Yes, Tesla is going to be coming to India. But history suggests that, in fact, any kind of bad news on Mahindra & Mahindra actually has turned out to be a buying opportunity. So let's see how that goes. And let's see whether or not Mahindra & Mahindra has, a joker up their sleeve as well. I'll keep an eye out on that stock, particularly if there is some weakness.
All right, Nigel, thank you very much for that. So keep an eye, Mahindra & Mahindra in focus. Well, we'll get in Matt Orton, who is now joining us, Chief Market Strategist at Raymond James Investment. Matt, great to have you with us here. Thanks very much for your time. So just a quick word on the IT results so far. The commentary also is pretty uncertain. We got numbers from TCS, HCL Tech, of course. There will be reaction today. Infi will come later. What's your sense, and where does that leave you with IT names in India?
Hey, good morning, Prashant. It's always great to join, and the results aren't great. It's also not that surprising to have fairly weak results. When we talked a month or so ago when I was in Mumbai meeting with a number of these companies, some of them included the information technology service names, and while they were a little bit more optimistic about what demand might look like a year plus out, the near term was still very, very uncertain. So I think there's still some speed bumps that the sector needs to get over. I think it's going to take at least another quarter or two. And so this is a part of the market that I wouldn't be looking to buy on dips right now because the fundamentals aren't there. But for the Indian market overall, I think there's still a lot of really good opportunities across higher quality single stocks where you are seeing solid demand. You're seeing very strong macro tailwinds, and those are the types of names that I would want to lean into on weakness, like an M&M, for example, like you were mentioning at the start of the segment. That's a name where I've always been a buyer on dips, and I still continue to believe that the fundamentals remain strong, and I don't think any competition from Tesla is going to disrupt their launch of EVs and their ability to have success in the Indian market.
Okay, so that answers the second question that we had, Matt. You made it pretty clear that you still like Mahindra & Mahindra. You don't expect Tesla to really disrupt that market, at least their market, too much. So what else? When you're talking about high growth opportunities here in India, we've always spoken about some of the banks, the large banks that you've liked. Anything else that you're taking a closer look at right now?
Yeah, Surabhi, some of the cleanup I've been doing across my portfolios has really included aligning across some of the big thematic drivers of growth going forward. So we've talked about how artificial intelligence can play into this, names that are using artificial intelligence to better enhance margins or find client data or expand. Geofinancial has been a name that I've liked more and more. It's still working across the market. Changes to how people are consuming, so names like 197 Paytm, that's another name that I think continues to look attractive. I've been a buyer of that on dips. There haven't been too many of those over the past number of months, but that's another one that I think analysts have not liked for a long time. And you continue to see the name beat that, and people have to catch their expectations up. So I think there's a lot of opportunities across, more unique types of names, and also weakness across travel. After the Air India travel, you saw a little bit of a sell-off to Interglobe, but that's another very high-quality name. They continue to order a number of new planes, and they fulfill those orders and continue to place more. And so when I look at where the fundamentals stand there hasn't really been that much of a dent to actual travel. And when I listened to what Delta in the US was talking about last week when they reported earnings, you haven't seen too much of a change. So that's another part of the market that I like to buy on weakness.
Hi, Matt. Good to see you. And Matt, so in terms of the entire global equity setup, it appears that India is standing out for you, and you have been maintaining that stance as well. So if you're allocating fresh money to the global equity markets, how much does India get and how much the rest? If you could just break that up for us. First, if you're allocating money between debt as well as equity and gold, and then in fact, within equity, how much does India get?
Yeah, great question. And so when I look at the portfolios today, fixed income isn't as compelling as it used to be as a diversifier, particularly US Treasuries, given some of the uncertainty that's out there at a macro level with respect to the Fed, the big, beautiful Bill Act that was passed. That's going to benefit equities much more than fixed income for right now. But I like gold as a diversifier. If you're concerned about volatility in the market, I think gold continues to look compelling. You still see strong central bank buying, especially from China and Russia. I think there's a number of reasons to have support there. So a couple of percent in gold in a portfolio, I think is a great way to help diversify. When I look at an equity book overall, which I think one should be overweight equities in this market because this is a risk-on environment, and the fundamentals across markets like the US, India, Europe continue to look very, very attractive. So India, for example, in my portfolio represents over 10% weight, which is the largest single country weight outside of the United States. It's very overweight relative to what it is in a global portfolio, but I think the fundamentals justify it. You cannot find the level of GDP growth that India is producing that's expected to sustain over the longer term, along with very solid earnings growth potential that's being realized and continuing to increase with respect to expectations. So I think investors are very underweight to India from a global perspective. And as flows start to catch up, I think that can benefit, especially passive flows with a weak dollar. You should continue to see money move into emerging markets, broadly speaking, which can also benefit India as you see those passive flows start to move into the market. So that's the general setup for how I would look at risk in a portfolio.
Matt, a lovely conversation as always. Thanks very much. Appreciate you joining us here on CNBC-TV18.
Thank you.
Well, let's talk about the inflation numbers here. The June consumer inflation comes in at a 6.5-year low of 2.1%, lower than CNBC-TV18 poll of 2.3%. Now, to look at these numbers, here's the editor's take with Lata. Lata, morning.
Good morning. Yes, an ultra-low inflation number. It's a 6.5-year low, the lowest since January 2019, just for the record. But importantly, it's been dragged down by food inflation. We can't even call it food inflation because it is deflation. It is minus 1.06. Prices have fallen by that much year on year. And the CNBC-TV18 poll actually expected flat, 0.1% rise. But this has come in deflation. And remember, the WPI also threw up a deflation in food. It's something we have to watch. To be sure, there is a high base, but this is an important level. The big fall is coming because of even month-on-month falls in cereals and pulses. Normally, by June, this fall in prices stops because, there is monsoon dislocation of, supplies. As we look at veggies, veggies are up 7.5% month-on-month. June over May, which is normal. I mean, because again, supply dislocation, vegetables begin to rot. But if you look at the year-on-year, vegetable inflation is down by about 17%. So that's the extent to which food is not an issue. Core CPI has come in at 4.4%. Core is when you take out food and fuel, whatever is left, largely services. That's come in at 4.4. That also because it includes gold. That's also because there is a low base. All this base will evaporate. Even gold will plateau on year-on-year terms. So we are going to see core inflation also falling. The expectation is July is going to be below 2%. 1.8 is a kind of the dipstick survey for me. And there was one person with a reading of even 1.5%. So that's the kind of low for the full year. Most people are now looking at, below 3% below 4% for all of 2025 calendar. For the full year FY26, people are now looking at 3.3, 3.4. 12 month, that is 3.3, 3.4. RBI is standing at 3.7. So now the market is pretty sure there is space opening up for another cut. And more importantly, that liquidity will continue. See, if too much money is not pushing up goods prices, that's what you normally worry, too much money chasing goods and pushing up prices. If that's not happening, then, the Reserve Bank will be more relaxed with liquidity. So chances are we are going to, start seeing the bond market pricing in a rate cut. Yields didn't fall yesterday. They were open. The bond market was open when the numbers came. Yields didn't fall. That was because of US yields going up. But space for rate cut is clearly opening up.
Okay, all right. Thanks a lot for that, Lata. Well, time to slip into a quick break. On the other side, we've got a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. For the time being, I highlight the list. Sun Pharma, Rallis India, Power Mech Projects, Railtel, Oberoi Realty, Inox Wind. All of them will be reacting to positive news flow. You have HCL Tech, City Gas Distribution Companies, Tata Tech, Tejas Networks will be reacting to negative news flow.
Welcome back. So like we've been telling you that Qs across Asia are not too bad actually. Even some of the regional markets like the Hang Seng, for instance, is up almost 1% right now. Now, will some of it rub off on us or not is the question. The Japanese market's up, the Hong Kong market is up. Let's look at the implied open. Implied open last time was absolutely flat. It hasn't really changed much right now. So we'll see how it plays out. But as always, lots of stocks to track. So our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Rima, let's start with you. HCL Tech, a lot of focus on the margins for obvious reasons. But you tell us, what did you make of the numbers?
Well, clearly there is a margin miss. So Q1 was a mixed bag. Revenues were muted, but in line with expectations, maybe even ahead. But margins disappointed. And the company has lowered the full year margin forecast from 18 to 19%. It's lowered by 100 basis points to 17 to 18%. And that's because in Q1, margins declined by 160 basis points sequentially to 16.3%. Impacted because in one project, there was a delayed ramp up, but the company had already staffed strength. So utilization had declined. There was a client bankruptcy, plus higher generative AI and generally investments. The full year revenue forecast has been narrowed from 2 to 5%. It's increased to 3 to 5%. That said, the company said they haven't seen a deterioration in demand. There were 2 large deals, which for procedural reasons, not because of macro uncertainty, got pushed from Q1 to Q2. So that is likely to close. But the interesting thing is that we'll watch in greater detail as it unfolds, is the company has planned a restructuring exercise. It's non-HR, which means they're planning to optimize some of the underutilized assets, in land, etc., or offices that they have, but also on the people side. And that is also going to impact. There's going to be a one-time cost associated with it. So with respect to people, what they plan to do is going to be of interest for everyone. Back to you.
Okay, all right, Rima. Thanks a lot for that. Well, let's hop across to Ekta. She's here to tell us about Sun Pharma. Morning, Ekta.
Well, yes, I'm watching Sun Pharma because they've announced the launch of the specialty product Lexcelvi in the US markets. This announcement of a launch is after the settlement of a patent dispute with regards to this particular drug. Lexcelvi, remember, is approved for alopecia at this point in time. And this is basically one of the key launches in the specialty segment that the street was watching out for. It has come probably a little earlier than what the street had anticipated as well. Now, analysts say it could be around a $300 million product over the next 3 to 5 years from this particular date of launch, and could probably even scale up to be the second largest product after Illumia, which is in their specialty portfolio.
Okay, all right, Ekta. Thanks for that. But going back to Rima, she's had a very, very busy evening. But Rima, you're off the blocks first. You'll be done first as well. But tell us, Tata Tech and Tejas Networks, both of them came out with numbers. How were they?
So Tata Tech Q1 was disappointing. The company's reported a revenue drop of 4.6% quarter-on-quarter. Margins missed street expectations. EBIT margins at 13.6%. But what the street may like is the commentary, because the company is optimistic about a sequential recovery in Q2 and a stronger second half of the year. Tejas Networks is a disappointing set of numbers. But here you remember that numbers are generally lumpy. But this quarter, revenues have fallen between 85 to 90%, both quarter-on-quarter and on a year-on-year basis. And the company says this is on account of the delayed purchase order from BSNL. There were certain shipment clearances for a few other customers which got delayed. Now, because revenues declined 85-90%, this time the company reported a loss of 126 crore at the EBITDA and a bottom line loss of more than 190 crore rupees. Back to you.
Well, that is Tejas for you. And, Tata Technologies, of course, is the company which we're going to focus on. And coming up at 9:30 with a conversation on the numbers. Well, city gas distribution companies are the next set we're going to focus on. Sud is here to tell us why these should be in focus. Good morning.
Morning, Prashant. So yesterday in the evening, late evening, PNGRB, that is the regulatory body for the oil and gas companies, has issued a public notice for city gas companies flagging irregularities in the pricing for the supply of gas to domestic consumers. PNGRB is saying that some of the city gas companies are following telescopic pricing structure in the supply of gas to domestic consumers. So what does this telescopic pricing structure means? It means that if you are using gas above a certain threshold, you will be charged extra. And PNGRB believes that this is in the violation of rules. It's applied to another sector like power, but as far as city gas company is concerned, it's not in the rules, so it's in the violation. Now, PNGRB has asked city gas companies to review and find out if there is anomaly and to follow a uniform rate irrespective of the usage. Now, why it is negative for city gas companies? For example, for MGL in FY25, domestic PNG had found 14% of total volumes, while for Gujarat Gas and IGL, PNG domestic formed 8% of total volume. That's the reason I'm going with red for these companies.
Okay, all right, so got it. So the regulator's watching closely, and it doesn't want any discrepancies in the way piped natural gas is priced. Thank you for that. Let's quickly move on then and talk about Rallis India. Sonal is here with the update on this one. Morning, Sonal.
Good morning. Well, it was a good set reported by Rallis after a lot of quarters of disappointment. So it was a revenue growth of 22%, EBITDA was up 57%, a margin expansion of 300 basis points to come in at 15.7%, and profits doubled on a YOY basis as well. The company says it was led by good volume growth and double-digit growth across their segments. And in terms of their segments, crop care did well, revenues up 16%, seeds revenue grew by 38%. So it was a good set. We'll be watching out for management commentary in a conversation that we'll have later on the show.
Indeed, we look forward to that. Rare voice. Thanks, Sonal, for that. We'll try to get some clarity. The management, remember, will be joining in at 9 a.m. to detail their past quarter's numbers and the way ahead. But let's wind this down with Vamakshi. She's joining in to tell us about some stocks in the news. Morning, Vama.
Good morning, Nigel. Let me first start off with a couple of order wins. Keep an eye out on power mech projects. They managed to secure 2 orders worth 551 crores. One order worth almost 500 crores from SJVN Thermal and a 53 crore order from Jabua Power Limited. Railtel is the next counter we're watching out for on the back of an order win. They've received order from the East Central Railway. This is an Kavach order which is worth almost 264 crores. So going with the green for both of these counters. Oberoi Realty, on the other hand, a consortium that was led by the company has won 919 crore resolution plan for Hotel Horizon in Mumbai's Juhu. Keep in mind that Hotel Horizon owns a prime 7,500 square meter land parcel in Juhu, and this acquisition aligns with Oberoi Realty's core business strategy. So green for this counter as well. And lastly, keep an eye out on Inox Wind, going with the green for this counter because there is a board meeting that is scheduled on July 17th to consider fundraising plans via rights issue as well as some other means. So watch out for this counter as well.
Okay, all right, we certainly will. Vamakshi, thank you very much for that. So let's quickly recap our list of top stocks to watch. The ones that have positive news flow around them are Sun Pharma, Rallis India, Power Mech Projects, RailTel, Oberoi Realty, Inox Wind. Stocks with negative news flow around them would be HCL Tech, City Gas Distribution Companies, Tata Tech and Tejas Networks. Okay, that's a stock list for the day. Let's quickly move on to commodities now. We have Manisha joining in with a roundup of all the overnight action. Manisha, good morning. So what are the big headlines?
Morning, Surabhi. Thank you for that. Well, the headlines really are in sense of profit-taking that we've seen across both. The crude oil prices extending decline, 2% of a fall overnight. Markets were anticipating an immediate U.S. sanction or restrictions on Russia. But what we have is U.S. giving Russia a 50-day deadline to agree to a ceasefire. So there's no immediate action. And the U.S. while has warned Russia of further sanctions up to 100%, but that's not happening immediately. So it's 2 months away, and that is what the markets have led in sense of easing of prices. Also, U.S. putting higher tariffs for partner countries does not augur well for economies and demand going forward. That is the other reason that you have seen a decline coming in for. But it's not just about energy. When you look across at metals, it's a similar scenario here as well. Gold and silver prices fell 0.5% each overnight. Copper is down 1%. Platinum down 4% as well. What the markets will want to watch out from here is the U.S. inflation numbers, industrial production and retail sales. So there's a lot of data coming in the next 2 days, and that is what would give markets reaction.
All right. Manisha, thank you very much for that. Well, we'll take a quick commercial break here. We're going to come back with Amnish Agarwal of PL Capital for some fundamental stock conversation. We also focus on Tesla's first India showroom right here in Mumbai, which opens up. Our colleague Parikshit is standing by with details there.
Welcome back. You're with us on Bazaar Morning Call. Well, let's focus on the big event of the day. And the Tesla wheels are rolling into India. The launch event is slated for right here in Mumbai. It's going to be at BKC. And Parikshit is already on the ground to get us all the action. Parikshit, so, I mean, it's become a bit like the iPhone event, right? But I don't know if people are already queuing up or not for those cars. But a big moment for Tesla.
Of course, it's a big day, and there is a lot of crowd gathering here. Right now, there's a lot of camera persons, but I'm expecting a lot of people to be here shortly, especially once the showroom opens. It's only going to be the media and influencers today. We've got the slot at 10:30 this morning. The showroom is right behind me. In a short while, you'll have the Maharashtra Chief Minister, Devendra Fadnavis, who will be coming. The Maharashtra Transport Minister, Pratap Singh Naik, will also be here. Through the day, there are at least 3 sets of launches that will take place. Tesla will be giving a briefing as to what will be the timeline for bookings and deliveries. All of it is going to happen very soon. Tesla knows the importance. They know that there is competition building up. In fact, as we speak, VinFast has opened up bookings for the India market. VinFast is the Vietnamese EV maker. But very quickly, I'm going to ask my camera person to pan in. The car that you see over there, which is kept under wraps, it is the Model Y. For the moment, they're only launching the Model Y in India, which is a compact, mid-sized SUV. It can give you a range of around 530 to 540 kilometers. The top speed is around 200 kilometers per hour. It can go from 0 to 100 in 4.6 to 5 seconds. Will there be more products? Well, the company tells us, yes, there is a product pipeline in the Asia-Pacific region. They can bring in many more cars rapidly, but they don't want to glut the market. They want to gauge the customer response. Currently, the Model Y that is parked behind me, it has a cost of around 37,000 US dollars in America. In India, that is around 32 lakh rupees. Add to that a 70% duty, and the car would cost you around 52 lakh rupees. So that's a high price point, but you get all the bells and whistles. The latest upgrades, this car also has FSD or full self-driving option under the driver's supervision. So let's see if that autopilot and all these autonomous driving features are offered here as well. But some disappointment, Elon Musk is not likely to be here, but there will be some global teams which will be briefing the media about the India launch.
Very, very interesting indeed. Action-packed. How will India greet Tesla? And how will Tesla make sure that it perhaps does the necessary tweaks to appeal to the Indian market? So indeed, big day for the automotive sector. Thanks very much, Parikshit. We'll keep coming back to you. It's going to be a busy day for you, and we will keep coming back to you for all the updates. Well, that's the big story with the global EV giant all set to roll out in India as well. With that, let's move on to our fundamental guest of the morning, Amnish Agarwal, Director Institutional Research at PL Capital, is with us. Amnish, morning. Thanks for joining in. You know, we were just talking about this earlier as well before you joined in, because the market for now is not too worried about Mahindra and Mahindra. We just heard Parikshit talk about the price points, and it seems this particular, the first model that they're going to sell, it's going to be between 50 to 60 lakhs. So would you say that M&M current shareholders don't need to be worried at all? Or could it trigger some kind of profit taking just because the stock has done so well?
Yeah, hi. You see, if you look at, say, M&M, its portfolio and the way it is positioned, I think there will not be any impact on this. First of all, the price points are very different. Secondly, if you look at EV sales, for example, you look at Tata Motors, some of the other companies, they were rising very fast, say 12 to 15 months back. But since then, the sales have actually come off, and now the growth is not much there. Even globally, the EV sales are not rising as they used to be in the past. So I don't think that in the foreseeable future, EVs are going to fully replace or make a substantial dent in the market for, you can say, internal combustion engines. So to that extent, I think there will not be any major impact which is going to come on M&M or for any of the ICE engine companies in the near future. And I think given the fact that M&M is the only PV player which is giving you double-digit volume growth, plus even the tractor outlook seems good given the monsoon outlook, I think M&M actually is a good stock to pick up at the current levels.
Okay, got it, Amnish. And in fact, history as well suggests if there is some nervousness because of a new entrant Tesla, then a Mahindra, if you bought it, then you've made money. So let's see how that goes. That said, tech has started off earnings and it's actually been disappointing. What's your view on the tech stocks? And will you all be looking to buy into any of these stocks if there is weakness?
You see, we have been negative on the tech stocks, and I have been underweight on this from, say, I think at past few quarters. And my belief is that till the time there is, you can say, there is some pickup in demand from Europe, both in auto and some of the other segments. And there is, you can say, end to this geopolitical uncertainty, plus this tariff, you can say, news daily going up and down. I think the major players in US as well as Europe, they are not going to increase their tax plans. So given this backdrop, I think there is going to be uncertainty in the near to medium term, and the growth rates are likely to remain low. Given that, and the valuations for most of the companies still in a band of 20 to 25, I believe that many of these stocks are just dividend yield, and I would still tend to avoid all the tech stocks at the current juncture.
Okay, all right, got that, Amnish. You know, in terms of more sort of stocks in focus today, we're watching out for the entire city gas distribution space, because there's some chatter on the regulatory front in terms of how they're pricing pipe natural gas and whether there's an anomaly. So the regulator is looking at the companies with the clear magnifying lens. How do you find the space overall? MGL, IGL, what's your current call?
You see, if you ask me in the longer term, the city gas distribution companies, they have not grown in a very, very significant manner, because For many of these companies now, the competition is open. That is one. Secondly, the margins which they are making are already healthy. There is not big room to, you can say, increase the margins from here. These are highly cash generating companies and the dividend deals are there for many of these. But having said that, these are not growth stocks. And so if someone who is looking to buy into these stocks from the viewpoint of making appreciation, I think that is something which might not materialize even over the medium to long term.
Okay, all right. Just coming to you with more specific questions, but HCL Tech is the other one we want to talk about, right? Mixed set of numbers for the first quarter, margins coming in below expectations. In its earnings call post numbers, the CEO and managing director of the company said that margins were impacted due to lower utilization, delayed ramp-up of projects, a project actually. Listen into some of that commentary.
We observed that the environment remained stable from an overall perspective, with some variations across specific verticals. It also did not deteriorate as feared at the start of the quarter. Our operating margin came in at 16.3%, which was lower than our plan. While Q1 has been historically the weakest quarter for us, the below plan operating margin was driven by the fact that our utilization dropped due to a delay in ramp up for a specific program. We also had a one-time impact from a client bankruptcy. We had a couple of large deals in the pipeline which were expected to close in Q1. These deals have moved to Q2. This delay is unrelated to external factors or macro factors. We are optimistic about their conversion, and if all goes as per plan, the TCV number should see a step up in the coming quarter.
Sandeep Agarwal is now with us, fund manager at Sovilo Investment Managers. Sandeep, good to have you with us here. Good to have you back on the program. Prashant here. What's your sense, Sandeep? The numbers that you've seen so far, the commentary seems a little bit more grim, optimistic. I mean, it kind of sort of ties in with what your view has been for a while.
Yeah, hi, good morning, Prashant. And if you see the numbers, they were really, not what we have anticipated and the street was expecting. So lower numbers. Unfortunately, the bigger problem is that, margin guidance have been brought down. Now, if margin guidance is brought down by TCS by 1%, the impact on EPS is 4-5%. But if it is brought down by HCL Tech, the impact is 7%, 6 to 7%. So that is the biggest challenge. And, it clearly reflects what we have been saying for quite some time now, that this is a mature industry for large caps to grow beyond 5-6% on a steady state basis with slight improvement in EPS due to buyback. I don't expect beyond that anything on that. And to that extent, all the stocks are very highly priced in the large cap, mid cap and small cap. While growth in mid cap is 2-3% higher and small cap is 4-5% higher, but the PEG ratios are even much higher. So I think the sector is very mature, primarily because outsourcing has peaked out to a large extent in the major market, that is US. Now the incremental outsourcing is very, very low. We are at 96% market share already. I think, this industry is now mature for growth. I don't see big growth coming in next 4-5 years at least.
4-5 years, grim, unless the models change. Sandeep, hi. So, HCL Tech is speaking about some sort of a restructuring. Now, we don't have too many details, but I think they're basically saying that it's aimed at bringing margins eventually back to above 18%. They look at better utilization of their facilities outside India, etc. How do you view this exercise? I mean, and they're also talking about Gen AI costs, etc., upskilling. I mean, basically, my question is, how do you rate these large IT services companies' attempts at trying to remodel to capture more of this Gen AI opportunity?
So I will tell you that, last 30 years, I've seen many disruption, but nothing like Gen AI and agentic AI. This is complete disruption of the business model because efforts are going down so much. I will tell you our own personal experience. Our efforts within the organization with use of Gen AI has gone down by 70-75%. Now, if that is the pace at which we, a small firm, are able to reduce the efforts, you can imagine what kind of effort reduction would have happened. Now, what is happening right now, because of that, the bench strength or default bench strength or the utilization is showing up in numbers which is lower. What companies will do, in my view, in next 2 to 3 quarters, they will start recruiting lesser and lesser number of people. They will try to first use the bench. So some improvement in margin will show up, but growth will not come because efforts are substantially going down because of use of this newer technology, which has not happened in the past disruption. So this disruption is really killing the efforts which are going into the system.
Do you have an estimate? I know this is tough to gauge at such a wide global level, Sandeep, but you gave us an example that for your firm, the effort required is down by 70%. I mean, just in terms of sheer manpower because of Gen AI. So what is the cutback that we are perhaps going to see over the course of this year and maybe even next year in just the requirement for bread and butter type of IT services?
So I think the volume will substantially go down every year. So the growth which we were getting earlier, 7-8% kind of growth and volume or efforts, I think that growth will be muted to 4-5%. Remember, it will be a slow process because the technology itself is evolving. So as you get the new client, new requirement, which is generally 1 to 2% of total budget, so it takes 4 to 5 years to see the whole impact. But in my view, that's the reason I'm saying 4-5 years you will see 5-6% growth in best case scenario for the large names. Beyond that, I will be very positively surprised unless these companies are able to reinvent and bring in some platform revenues and some massive change and restructuring in the whole business model. Otherwise, 5-6% effort growth will be a very, very good effort growth in my view.
All right. Hi, Sandeep. Good morning. Good to hear your thoughts. Sounding a little bit cautious, though, and a little disappointed with the numbers that you've seen so far. I wanted to ask you particularly about, not the large IT companies, but the more mid-sized, like a Tata Tech, or a Tata Elxsi. Now, some have been saying, in the last 3 years, you made no returns on big tech. But if you bought these companies, then you're actually down 35-40% as well. But still, the numbers not very, very impressive. What do you make of these stocks? Is it providing you an opportunity? Because once growth picks up, then these guys will outperform on the growth side. But in the near term, there is a lot of uncertainty.
Yeah, hi, Nigel. It is a very good question. So if you see the ER&D space and the non-traditional IT services space, they are going to grow at least 4-5% higher than the traditional IT services, which is the space where, some of the mid caps and small caps are operating. There is some challenge in Europe, auto, and some places there are some problems. Because of that, these companies are struggling. But the question is that, even if, let's say, these companies are able to grow at 11-12% for next 4-5 years, on revenue terms, the margins cannot go up substantially because they are doing good margins and the wage cost hike is real. So in that case, if you are giving them 40-45 multiple, I think that is too much stress. So in my view, the problem is that where there is growth, the multiples are very demanding. And where there is low growth, there also multiples are demanding. The only rationale which I see today, even when we manage our PMS internally, is that, we will replace some of the FMCG stocks with technology stocks because the growth numbers are similar, but the multiples are 30-40% cheaper than FMCG. So I see only that rationale to buy technology today in my fund. Other than that, there is no fundamental rationale to buy these stocks, even after time correction, price correction, which has happened.
Guys, you should listen to this
Says it as he feels it. Sorry.
The Anthropic CEO, who was earlier with OpenAI, his interview on CNN, this is, I think, about 10-15 days back, just absolutely, because, everything is coming from there. We are kind of sort of reacting to it from the US, essentially, from 3 or 4 large companies, right? Yeah. So, I don't know if you wanted to scare everyone, but that's...
I think Sandeep's also done a good job of that. He's sounding very dire, but I guess it's that level of disruption that we're seeing.
That's what he believes, but I know Sandeep has strong views on this as well, but we'll get him back and we continue to chat with him about this. Thanks very much, Sandeep. Great to have you with us here. Appreciate your time here on CNBC-TV18. What we'll do is take a quick commercial break here. We'll come back with some technical trading ideas. Sudarshan and Mitesh on the other side. Okay, welcome back. Sudarshan and Mitesh are with us with technical trading ideas. Gentlemen, morning. Great to have both of you back with us here. Mitesh, we tested the 40-day exponential on the Nifty and then kind of sort of bounced a little bit. The Nifty Bank around the 20-day. What is your sense? Will these levels hold where we are, or maybe a little bit more on the downside?
Morning, Prashant. See, my idea is that the Nifty has turned slightly negative, and there's a good chance that even if there's a pullback, I think we'll find it difficult to get past 25 to 5300 zones broadly, and a good chance we will test 24,850, 860 levels to begin with. In case we break below them, we'll look for a slightly deeper correction, but the overall belief is that we are more likely to head towards 850, 860 to begin with, and then maybe lower. And the rallies should be used to take some kind of short exposure on the index around this 24 to 300 zones.
Okay, so looking at maybe some shorting opportunities. Got it, Mitesh. A morning to you as well, Sudarshan. What would your index call be, Nifty or Bank Nifty?
Yeah, good morning. See, the Nifty has been a little bit of some kind of a tiredness has come in the Nifty. That sense of tiredness brought the Nifty down 600 points. There was no big reason. The market just got felt. It had nothing to do, so it fell. In the same way, I think the markets can rally because there's nothing to do. There's nothing upside, nothing on the upside, nothing on the downside. This rally should be used to sell, and Mitesh is quite right. If we see 200 to 300 points of an up move, that's a shorting opportunity. Buy put options at that point, somewhere around 25, 300, 350. It's difficult to give a level because you don't know where the rally will stop or end. But that is the trade. Now, intraday trades is for today, they are both because the markets are a little confusing. You look to buy an intraday trade and look to short a positional trade at higher levels.
Both sounding a little bit cautious on the index. Good morning, gentlemen. Sudarshan, you go first. Individual stocks, what do you have on your radar?
Well, I have Fortis, and despite the big rally, there is a buying opportunity in Fortis with a stop under 739. Adani Green is a buy with a stop under 975. AB Capital has been a consistent outperformer. That's a buying opportunity still with a stop under 263. And a very unusual stock for me, Patanjali, which went into a bear market, has been moving sideways for more than a month. Maybe a positional buying opportunity. It's worth finding out. Keep a tight stop at 1580 and buy it.
Sudarshan, you have any specific trades on IT names?
No, I've just heard that commentary and that was so depressing. And IT is not the favorite sector. Technically, if you see the charts, you will see it making a complete underperformance.
Yeah. No, I meant trades on the sell side. I mean, maybe not. It's already kind of sort of corrected already. Mitesh, for you?
I have a mix of buy and sells today. Though on some stock side, there are buying calls, but to me, IT looks a weak sector. But I'll just cover the calls first. Hindustan Zinc, and I think there's some traction with silver prices making higher highs. Hindustan Zinc is a buy with a stop at 430 for targets of 450. Adani Green is a buy with a stop below 1,000 for targets of 1,080. A sell on AU Bank with a stop at 816 for targets of 780, and Biocon is the final buy call. Keep a stop at 372, look for targets of 395.
Got it. All right. Thanks a lot for that, gentlemen. Well, for the time being, we take a short break. Come back, we'll get a pre-open rates. We'll also be joined by the management of Rallis to discuss their first quarter numbers. Welcome back. Well, in a few minutes, we'll get the pre-open rates that should come up for you on the screen. But let's continue our conversation with Avnish Agarwal. Avnish, what about companies like Rallis? The numbers look quite good, but a couple of brokerage reports suggest that you don't need to look at quarter one in isolation. Maybe quarter one and quarter two clubbed together will give you a better picture. Any view on this name?
You see, Rallis has been actually underdog from the past few years. And as you rightly said, 1Q and 2Q, depending upon how the monsoon plays out, how the placement in fertilizer pesticides are. So there is usually a lot of fluctuation, and one should look only at 1H and 2H for Rallis in particular. But having said that, at least in the 1Q, the numbers are better on a YOY basis, so that is positive. But the issue with Rallis has been the consistency in performance. So if they are able to sustain this kind of a performance, if they are able to show better numbers on a YOY basis, on a sustained basis, even in the coming quarters, then one should be looking at the stock.
Okay, all right, got that. Avnish, wanted to ask you about a couple of other names then. From the FMCG pack, what do you like? What's your top pick out there?
You see, currently ITC is a stock we are positive about because the stock actually corrected from above 500 to the current levels. That is one. The second is that currently it is facing a lot of margin pressure across business segments, whether it is cigarettes, whether it is paper and paperboard, and even in FMCG, both margin and sales are under pressure. So our view is that maybe by the end of 2Q, all these margin pressures will tend to abate. And there are early signs of that already visible. And once that starts happening, I think the momentum will come into this stock. And given the fact that the growth rate visibility is not there in most of the other stocks, many of our earlier recommendations, they have more or less played out. So ITC currently is the top pick in the staple space.
Top pick in the staples place at this point in time. Just a couple of more names if you have any thoughts. And we're speaking with, by the way, this company later today. Ola Electric actually was the #1 volume-led gainer yesterday. And of course, it's been a bombed-out name, ended sharply higher. Any views here, Amnish?
You see, Ola has been actually going down if you look at past 2-3 quarters, quarter on quarter. And the issue with Ola has been that over the period of time, they have lost out on volumes the way they were growing year and a half back. So they have lost back on volumes. That is one. Secondly, there were a lot of quality issues which had come with the company. So I think at the current juncture, it is more like you can say if someone wants to take a punt on the speculative news or the market, say, then one can have a look at stocks like Ola. But otherwise, I think it is very difficult to take a fundamental call at this point of time.
No, absolutely. I just want to make a quick mention. I don't know if we have the if you have the Hang Seng Index, the live rates. If we can show it up, we can show it what's happening. I think there is a bit of a bump which we've seen come through since we even started, actually. So the Hang Seng, if you can able to pull it up. Okay. I don't know if this is live, but I think from where we started in the morning when I was looking at it, there is basically been a bit of a bump which has come through. I'll give you the news, basically. The news is that NVIDIA, essentially in a blog post, has said that they are planning to resume sales of their advanced H20 AI chip to China. This is the sort of new information which has been revealed about 30 minutes back, basically. I think even there is some reaction on NASDAQ futures as well. NVIDIA is a big component of the NASDAQ. This is a significant change in tone, basically, because export controls with regards to the AI technologies, AI chips, etc., have been expanded by the US government in April. So this is a change in tone and tenor that we are looking at. More on this story as we kind of go along. But it's important with, of course, the bigger global stuff which has been in focus. Amnish, just one more name, and this is largely defense, which has taken a bit of a breather. Is it just a breather after the breathless rally we've seen? Garden Reach and BEL and HAL, everything just sort of calming down over the last 2 or 3 weeks now.
Prashant, if you look at, say, from the middle of May to, say, the middle of June or even, say, end of June, so many of these stocks rallied by even, say, 35%. If you look at the ordering momentum, that is very strong in all the defense companies. That is one. But having said that, now the valuations are not cheap. Whatever valuation gap was created in the month of March and April, now that valuation gap has got bridged. Will these companies grow well over the medium to long term? The answer is yes. But in the near term, I think many of these stocks might have, you can say, very little room for an incremental upside. And that is why we might see sideways or the weaker movements in many of these stocks from the current levels. However, in the long term, they continue to look good. And for the investors in particular, if you want to enter in the stocks now, then you need to have 2 to 3 years kind of view on these stocks.
Thanks a lot, Amnish, for joining in. Wishing you a good day ahead. We catch up soon to chat about stocks and the markets. Well, let's focus on one of the names we're just discussing, Rallis India. That's the first management on the show. It reported a good set of numbers in the first quarter. Strong margin expansion. The company says that EBITDA growth was driven by volume growth. We're now joined by Gyaninder Shukla, the MD and CEO at Rallis India. Hi, Mr. Shukla. Good morning and congratulations on a good showing. I think we'll need to look at it as quarter one and quarter two together to get a better sense. But it appears that first half of the year is going to be pretty good. Now, you speak about strong volume growth this quarter. So could you help us out? What was it in crop care as well as the seed business? And what is the volume growth you're targeting for FY26? Please go ahead, sir.
Yeah, thank you very much. Good morning to everybody and listeners. Look, yes, one of the things is that this year rain has started on time rather early and has been fairly good spread of rainfall. That obviously brings cheers to the agriculture sector. So we are beneficiary of that. We had revenue growth across all three sectors. We are, and have been talking about three business segments we operate. One of them is crop care, where you have crop protection products as well as soil and plant health product, and then we have a seed business. And within crop care, we have domestic business as well as export business. So there has been, yes, a significant uptick across the segment. I cannot rule out any one particular segment. And as for the fiscal year 26 forecast is concerned, as we said, our goal remains to start delivering high double-digit growth, over next horizon.
Double-digit revenue or volume growth?
Revenue growth. Now, revenue always is a more important criteria because sometimes you have to take a pricing decision. It's a combination of price and volume all the time.
All right. So double-digit revenue growth with mid-teens margins, or better than that, or a little less than that?
Well, I have been saying from the beginning we want to improve our margin from the last year, where we ended by 500 basis points on a long-term basis over a period of time.
Okay, all right, got that. If you could help us out, sir, how much were exports as a percentage of your total revenues? How did they grow? And you've been talking about the gradual recovery. Could you tell us how do you expect it to grow? And also, since we're talking about exports, just wanted to understand, will your company be better placed because of the tariffs that the US is putting on various countries in the world?
So of total 957 crore revenue we recorded, export is about 190 crore. Now, this changes from quarter to quarter. I think relative to last quarter, certainly significantly, we had a better quarter this year. But our CSM revenues were down because CSM revenues are driven more by agreements and the month you supply. But having said that, export market continues to, while it is continuing to grow on the volume side, prices have stabilized, but it's still a lot of uncertainty given the China tariff factor. So it's very, very difficult to say what will happen in the future. Having said that, we continue to develop our customer base, improve our customer base, our presence in the global market so that we can take the opportunity and be prepared for the opportunity whenever it comes.
Mr. Shukla, hi, morning. Prashant here. Two questions. One, the US-China, the US-India trade deal, right? I mean, agriculture is a thorny issue, access to markets here. And of course, the government will do everything it can to protect interests locally. But is that something you'll be watching for your business as an impact on the business? And second, has pricing bottomed across the portfolio? Different questions. Go on.
Yeah, so I think these trade deals, obviously, there's always some you gain, some you lose. So nobody knows what is there unless it unravels. So we'll talk about it when it happens. At this point of time, our focus remains on domestic business as well as export business. And on export, we continue to focus on delivering customer base, as we said, because I think we will continue to benefit in long term from China Plus One strategy, and we don't want to be left behind on that.
All right, Mr. Shukla, just to reconfirm, revenue growth in double digits is what you're targeting. Margins,
it's an ambitious target because industry grows in mid-single digit.
Yeah.
As a company, we have set out to grow ourselves, and that's goal, ambitious goal. But yeah, nevertheless, that's what our aim is.
All right, and on the export front, you said 197 crores out of the 900 odd crores is what you delivered. So more than 20% comes in for exports as of the past quarter. And the margin improvement last year, on an average for the year, you've been doing last 2 years around 11 to 12%. So this year will be how much better? How many basis points better?
So overall margin, obviously, so gross margins more or less remain flat. I think quarter one also has a higher percent contribution coming from seed. Seed generally is a higher margin business. Also, yes. Plant health business is higher margin business. So that is reflected in the overall number.
So we should work with the margin number of around 13-14%. Would that be fair?
Well, difficult.
EBITDA margin, sir.
EBITDA margin, yeah, I mean, currently we are at about 10%. No, actually it's higher. Just let me see.
First quarter was around 15% because of the higher contribution.
I think as we move forward, I think quarter two is going to be more domestically important. it has less weightage on the seat. So I haven't worked out those numbers for the Q2, but I mean, it's a mix of business that will dictate how things move forward.
But margin improvement is something that you're looking at, EBITDA margin improvement.
So as we grow revenue, we must improve our margin. That's our goal.
Got it. And you just briefly spoke about market share. You have spoken about that in the past as well. Q4, you said that, market share is something that you are going to be looking at. Give us a ballpark estimate. What is your market share in your targeted market? And how do you see that improve?
So it depends on the business segment. In India, one of the biggest challenges, nobody has a real idea about what is the market size of every segment. We don't have a systematic way of collecting data, but I can tell you, for example, in North India, where our Diggaz cotton is sold, we probably have become joint number one. That means, our volumes are up. That product is inching towards being a 100 crore brand now. So we certainly have moved our market position there, and that comes from the market share gain. Other markets, I think, is early season, is Q1. A lot of placement has happened. I think we have to wait for this further season to further play out before we can comment. I would say margin, market share we should see on a seasonal basis when Q2 numbers are out.
All right, Mr. Shukla, thank you very much, sir. Good speaking with you, and look forward to our next conversation, and hopefully by that time these deals, etc., would have been announced as well. Thank you.
Thank you.
Well, let's just get you an important programming alert. This big CNBC-TV18 exclusive coming up. The RBI governor will be speaking with our colleague Latha Venkatesh. And no big question, of course, is off the table. From inflation at a 6-year low to liquidity and global risks, what does it all mean for rates and growth? Catch the most definitive RBI governor interview post-noon today only on CNBC-TV18.
Okay, well, that's the big interview to watch out for. But in the meantime, let's quickly get back to the market as well. The pre-open has settled with the Nifty up just about 7 points. That's all that we're getting on the Nifty right now. Watch out for some of the earnings reactions. Rallis, the stock that we were just discussing, we're just speaking to the management, is up 5%. On the other hand, Tejas Networks is the biggest result disappointment since last evening, and therefore that stock's down 7% in pre-open. Okay, quickly getting back to our technical experts for some final trading ideas. Sudarshan, what would the 910 call be for you?
It'll be Adani Green, buy Adani Green with a stop under 975.
Okay, and Mitesh, what about you with stock?
Yeah. I'll go with a buy on Hussain Zinc for targets of 450.
Okay. All right, gentlemen, thanks very much for that. Well, let's also revisit a couple of important notes and calls. And obviously, HCL Tech is right top of mind this morning because of what's happened. I mean, on one hand, there is the top line decline, which is not as bad as the market feared, but then there is a big hit on margins. So, Reema, what's the bull versus bear case?
Well, just to revisit the key number in HCL Tech this time, as you rightly pointed out, the revenue performance was not that bad. Minus 0.8%, and much better than the 10 TCS, which was a minus 3.3%. But the company missed the mark on margins by a wide margin, and the company has lowered margin guidance by 100 basis points. It now stands at 17 to 18%. The brokerage verdict is mixed. JP Morgan downgrades HCL Tech to neutral. They say AI deflation is playing out via margin erosion. Nuvama too downgrades HCL Tech to a hold. Their target price stands at 1630. But on the flip side, there are upgrades to or bullish notes. So let me start with Jefferies, which has upgraded the stock to a buy, 1850, because they said that while, yes, in Q1, we've cut EPS estimates very marginally, but the EPS growth for the next 2 years is seen at 10%. And this is a company which will continue to outperform peers and therefore deserves premium valuation. Nomura also maintains a buy rating, and they believe the street should ignore the near-term margin miss or the margin guidance downgrade, because by FY27, the management is saying margins will revert back to their earlier levels. Also, therefore, the street should focus on revenue outperformance, which is why Nomura has a buy rating. CLSA too has a bullish call, outperform rating on HCL target price 1867.
Okay, quite interesting there. So the bull camp and the bear camp. But Reema, before you go, tell us about Tata Tech as well. Not very hot performance there either. Revenues down again for this company.
Revenues are down 4-5% on a quarter-on-quarter and on a year-on-year basis because of a negative, the revenue contraction. Margins have declined 13.6% EBIT margins, lower than expectations. But here the management is sounding bullish. They say that we expect sequential recovery in Q2 and a stronger second half of the year. But brokerages are largely still bearish on Tata Tech. I think 17 of them look at it and only 2 of them have a buy call. Majority of them, overwhelming majority, have a sell call on the stock given the rich valuations and the fact that their key business, automotive, is facing challenges. So Ambit has a sell call. They're saying the current market price, implies a 34 times a forward valuation multiple. Citi is saying this is a company which is going to see a revenue decline of 5% in FY26. Goldman Sachs too has a sell call 560 as the target price.
All right, I think we're hitting market open with just a few seconds to go. So let's just look at what the opening rates are, and then we'll come back with the specific stocks, etc. Indices as always first, and then we get into the other stuff. So 25,090 on the Nifty, absolutely flat. You got the Nifty Bank, which is absolutely flat as well. Sensex actually is all flat. 25,120 on the Nifty, 56,780 on the Nifty Bank. And like yesterday, you once again have the small cap index, which is up 0.5%. The mid cap index is up about 0.4, 0.5% or so as well. So, this is looking much better, about 0.5% roughly as far as broader markets go. And actually, even on the Nifty, after the last 2 days, there is a little bit of a bounce which is appearing. 50-odd points, 60-odd points, 25, 140 on the indices. Nifty heat map perhaps gives you a quick sense of how we are starting, in one quick full sweep, and then we kind of look at some of the other, some of the individual movers and shakers as well. So if you're pulling that up, I think we'll just be able to tell you. It just gives you, a quick view of how many stocks are up and how many stocks are down as far as the Nifty is concerned. But let's get to individual stocks now.
It's actually not bad. It's a 60-point up move, and there you go. That screen has a lot more green than red today, so it's a good start for the bulls. Sun Pharma is in leadership position because of this drug that they're going to be launching. It's a specialty product. It's a alopecia drug in the US market at 1.5% up, makes it the top Nifty winner. On HCL Tech, by the way, there's not too much disappointment. So that bull versus bear case that Rima very nicely explained, there is a bullish camp which is saying see through the near-term hiccups, and perhaps the longer-term story is not too bad, and the stock is recovering quite well. The other gainers today include a Tech Mahindra. There's some buying around Jio Financial Services. Eicher Motors is up. Tata Motors is higher. Infosys is also up and about. Reliance. So a lot of big stocks actually are chipping in on the upside today. Mahindra & Mahindra, stock in focus with that Tesla launch, puts on another 0.5%. So overall, it's a really good-looking Nifty screen, you'd have to say. The downside really is not much. Eternal is losing some ground. Eternal is down almost 1% now. So Zomato is off the charts on the red side today. And that's about it. Ultratech, Cement, LCL Tech, like I'm saying, is a little volatile. It's between 0.5% to 1% cut on HCL Tech. But otherwise, it's not bad. 50 points for the Nifty. The question is, can the bulls hold on to this and build on to this? Nigel.
Well, a couple of stocks that deserve special mention from the broader markets. Rallis India, the management sounded quite optimistic, gaining market share. The export market is presenting an opportunity. For this year, they're going to grow in double digits with margin improvement. Street likes that. That's after the race is up 6%. The other one is Tejas Networks. The stock is down. Now it's less than half of what it was at the peak. Obviously, it comes from a very good parentage, but those orders are not coming in and execution seems to be picking up. I'll tell you what, we'll have the management of Tejas Networks sometime during the course of the day, maybe in the next 90 minutes or so. So we'll try to probe them and get further clarity on this particular name. One positive on the Nifty itself is yesterday's high has been met in the first hour itself, or the first few minutes of trade itself. So 25,151, that was the high yesterday. The last 4 trading sessions, we've been seeing lower highs and lower lows. So today, after a while, we're likely to see a higher high. That'll be a little bit encouraging as well. So explains why that one is up and about. And Power Mech, they've won an order, so the street likes that. That one is up close to around 3% or thereabouts.
All right, no, absolutely. And lots of stuff moving around. Market breadth is pretty positive. Newland Laboratories was up big time yesterday. Newland is up another 3% this morning. And it's the number 2 volume-led gainer across the board coming through. Rallis, of course, is right there at the top, as we mentioned already. Railtel is coming up with a 3% pop, very large volumes for this point in the day. Deepak Fertilizer is up about 3.5%. Amber is up about 2%. Gillette is up 6%, 6.5%. It's got volumes as well. And that's the reason why we are mentioning it. On your screen, Triveni Turbine, Cupid has been moving, one way from $100 to 130 in 3 sessions now. So big move. Voltamp, there is Aeroflex, there is ABDL, the alcohol company, big mover yesterday. 2 days back, closed at 450, stocks at 500 plus now. AstraZeneca is up 4%, something like a Prime Focus. Prime Focus, by the way, was up, I think Circuit up yesterday. It's up another 3.5% this morning. So there is, and this is, by the way, I can go down, but then volumes start to disappear a little bit. But this is the bulk of what is going on at this stage.
Just wanted to point out, Prashant, that Rallis seems to have pulled up the entire agri/crop protection space today, because Rallis obviously is rallying on numbers. But look at fact, smaller stocks like Deepak Fertilizer, something like a Sharda Crop Chem.
Yeah.
So the whole agriculture space is definitely showing green today.
Absolutely. Well, let's, bring in our market master of the day. Mihir Vora is Chief Investment Officer at Trust Mutual Fund. Mihir, good morning. Great to have you with us here. Thanks very much. What are you seeing, Mihir, with, of course, earnings are just about kicking off and expectations are generally downbeat, muted, and IT has kind of shown the way in that sense. But what have you been busy with? Where are you focused on in finding opportunities? Because it's in large parts a fairly finely priced market. Let me put it that way.
Certainly. Good morning, Prashant. Always a pleasure to be here. So I think the market is in a no man's land, I would say. As you mentioned, there are flows which are coming in, and we've seen FIIs coming to the market. Domestic flows are strong. But on the other hand, the results season is likely to be a mixed bag. So there will be some pockets of disappointment, and there will be some good pockets. So I think it's going to be a very stock selective market, I would say. And the macro view is that liquidity, both locally as well as globally, will continue to be ample. So liquidity support will be there for the market. Fundamentals are a question mark, both in the more so, I would say, on the global markets, especially in the US, because of all the things that are happening there. There is a lot of uncertainty. China is also doing, it's a mixed bag. The Indian thesis is that while current data points are mixed on the economic front, the second half should be better because of the government initiatives and the liquidity that is flowing through. So I think for the next few weeks or few months, it's going to be a selective market and very, very stock specific. Results season should be very interesting.
But Mihir, hi, morning. The question really is, where can the pleasant earnings surprises be? The consensus is saying, I think that we'll get maybe 11-12% sort of earnings growth. But given how stocks are poised and where valuations are, where do you see maybe some pockets of pleasant surprises?
Sure. So if you look at sector-wise, my guess is that there are certain sectors which are coming off a low base last year. So these are usually the ones which we saw didn't do well in the first half of last year, linked to government spending. So some of the construction counters, the cap good counters, a lot of the government spending segments did see a slowdown, defense, railways, etc. So those are coming off a low base for the June 25 and September 25 quarters. So probably we have some kind of a base effect tailwind there. Metals also are coming off a low base, so you may see some pleasant surprise on the metals side. Banking's and NBFCs are going to be a mixed bag. So there it's going to be more a function of who has been able to manage the asset liability well. My guess is that on the whole, NBFCs on the retail side may show a little bit better results than the banks in general, I would say, because banks are still going to have some of the floating rate impact on their asset side because of rates coming down. NBFCs will be far more robust. So it's really going to be, pick and choose across the board. But in general, I would say the capex theme, the investment theme should continue to do well. Discretionary should pick up because we've seen some of the stocks really getting hammered down in the discretionary space, like some of the, consumer durables, auto stocks. So they offer good pockets of value. So while you may not have great results in some of these pockets, stock prices already are probably discounting a lot of the negatives.
All right. Hi, Mir. Good morning. Good to see you in. What are you making of the recent Deal Street action? We had deals on SML Isuzu, you had Akzo Nobel, and you had VIP as well. All those three deals got done at a discount in comparison to the traded price at that point of time. But all the three stocks, in fact, did well post the announcement of the deal, though the deal was at a significant discount to the traded price. Your view on some of these themes, do you believe, change of hands, change of ownerships, will you be betting on some of these stocks doing better in the time to come?
Absolutely. We've now had a good history of, in the last 10 years, we have seen some very good examples of companies either being taken over by strategic investors in the same field or by private equity funds and then done a lot of restructuring, management incentives, etc. And the outcome has been good. So in general, the outcome for the strategic stake sales has been quite good, because it does bring in a little bit of more professional approach, incentivizing the management, shaking up cultures at points in time. So there is a place for us being selective, but definitely opportunities do get created in the last 10 years.
All right, Mihir, got that. So bullish on some of these changes in management. Mihir, what about the capital market players? They were dancing away to the bank. Whether you look at the CDSL stock or the stock exchanges, brokerages, wealth management. Now, some of them have pulled back considerably from the recent peak. We know that there's a long runway, but temporary volumes have fallen. Would you be looking to buy into this dip, or you say that they ran ahead of themselves, so they need to cool down more?
Certainly, there is always going to be a period of cooling off and correction, and that's what we are seeing. Though the secular story will not change, frankly speaking, we also had this, the big hedge fund issue that probably has impacted volumes a little bit temporarily. But we have seen that in secular growth stories, there is always going to be overshoot, there is always going to be undershoot. I'm not talking about stock prices, but in terms of the trading volumes, etc. But the fact remains that as income levels rise, as savings rise, more and more investors will come into the picture, and in general, the growth rate of these segments will be more than the 10-12% that we are seeing for the rest of the market. So these sectors in the longer term, at least for the next 5, 7, 10 years, will continue to grow at a rate which is faster than the rest of the industry or rest of the markets. So in general, if you say that, are these going to be, if you ask me, are these going to be pockets of outperformance for the next 3 to 5 years? I would still say yes.
Mihir, we were just discussing IT with a sector specialist a while back. And at least he had a very, very negative view, not from a quarter perspective, but, several years perspective, because Gen AI is real disruption, and perhaps it's much bigger disruption than the whole cloud migration era. You've been hearing the companies and what they're saying. You're seeing the early numbers in Q1. What's your stance? Looking to buy for the long term at all?
No, we've discussed this. Structurally, we are bearish on the large cap IT companies because even without Gen AI, if you look at the longer term sense, last 5 to 7 years, if you remove the 2 or 2.5 years post-COVID, where there was a bunching up of tech investments globally, the growth rate had come down to sub 10% levels. And when we are talking about India growing at 6 to 7% in terms of real GDP, 10 to 12% of nominal GDP, corporate profits will grow at a higher rate. So we would not really be very excited about stocks and sectors which are growing at sub 10%. That's one. Same thing happened with FMCG. In the 80s and 90s, FMCG was a very fast growth sector, but then it tapered down, and you see the large FMCG companies also struggling to grow beyond single digits. So I think unless IT services companies in India dramatically rethink their service model, their delivery model, the value addition model, I think they will be stuck in this single digit growth rate, which to us is not very exciting.
Oh, okay. I think we're getting visuals from the Tesla showroom here in Mumbai. We can see Mr. Fadnavis there with officials from the company. Of course, we don't have Mr. Musk coming down for this India launch, but I think other senior global Tesla officials are definitely present. And that's the excitement at the store over there. Okay. All right, that's Tesla for you. I don't know, do we still have Mihir? I think, okay. Mihir, just a quick final word before we let you go. I don't know if you're buying a Tesla or not, but I don't know whether you continue to be positive on M&M, the EV story.
Won't like to be too stock specific, but the rural segment still continues to do well, I guess, and we are seeing that the premium consumption story still continues, so SUVs, etc. So we are playing those kind of themes. But I think this is the visuals that you showed are very close to my office. Probably I should go there.
I think you'll walk back with a new car. Who knows, Mihir? We'll talk in the evening. I'll call you in the evening. Okay. All right.
Take me for a drive, Mihir, if you do pick up.
Yeah. Please, we'll be there for a ride. All right. Thanks, Mihir, so much for that. Good conversation as always. We look forward to catching up again soon. Okay, we have the official pricing also out of the Model Y. It's almost touching 60 lakhs. Long range RWD is 67.89. And the earlier model was just under 60 lakhs. So pricing obviously higher than some of the Indian competitors. Let's quickly move on now. We have, of course, the management of Tata Tech joining in. The company has had a slightly weak quarter. Just to quickly recap the numbers, the revenue top line is down 4.6% quarter on quarter, and margins have also compressed slightly to about 13.6%. So we have Mr. Harris joining in to tell us whether this is just a one-off. Mr. Harris, great to have you on. That's exactly, I think, what you've indicated to analysts in the call, that this was because of some delays in certain deals, certain ramp-ups. But you're sounding confident about the rest of the year. What makes you feel this way?
Yeah, we continue to be bullish about the full fiscal year. I think the first quarter we entered with a great deal of optimism, but the tariff announcements early in April, I think, interjected an element of uncertainty, and many of the customers that we've been engaging with that were looking to make investments in new products basically paused and delayed some of those decisions. Now, the good news for us is that towards the end of the quarter, we saw some of those decisions get converted, and so we're taking a strong order book into the second quarter. And again, we continue to be confident about the prospects for growth throughout the rest of the fiscal.
So does that mean what, double-digit growth in FY26? Early teens, single digit, some indication?
I think we'll calibrate our expectations as we move through Q2. The North Star for us continues to be double-digit growth. We'll work hard to endeavour to achieve that. But I think a lot of it will depend upon the trade negotiations that are currently going on between the US and various trading partners. And I think if those things resolve quickly, then I think we can be confident about getting close to that. But we'll see over the next 3 to 4 months, and then in the sort of September, October timeframe, I think we'll have a better view.
Warren, hi, morning. The JLR, can you talk to us about the JLR account? How's that doing? Has that stabilized?
Sure. We have, we've been very excited about the performance and the progress that JLR have made, not just in the recent past, but in the last 4 to 5 years. They celebrated being debt-free at the end of the last fiscal year. I think that's informed some confidence in terms of their investment in new product. There is a lot of launches that we are supporting this year. And so we're confident in the JLR story and our ability to contribute towards that. And we're also very confident about the position that Tata Motors finds themselves in. I know that there are some tactical headwinds that they're navigating through, but the company has executed extremely well in terms of its transition to EVs. And I think the investments that they've made position Tata Motors not just for success in the short term, but also in the medium to long term.
Hi, Warren. Good to see you. Ben, a quick question on growth first. Couple of quarters of negative growth. Do you think that quarter 2 onwards, we get back to growing base? Point number 1. And point number 2, I've been looking at a couple of brokerages. The bearish ones are talking about a degrowth this year. You're ruling out that possibility?
Yeah, I'm very, very confident that we will not degrow, and certainly Q2 will be better than Q1. We will grow and we will improve our profitability position. And I'm very confident, again, given the order book that we've got, that we're going to have a very strong second half to the year. So,
all right.
Again, we'll calibrate exactly what that means as we move through the second quarter. But certainly, I have no doubt that we will grow this year.
All right. Endeavors to go to double-digit growth, but no doubt about growing this year. And quarter 2 will look far better. You briefly mentioned on profitability. I was just noticing your margins. It's come to around that 16.5 odd handle. Earlier, you were doing 18% odd. For the year on the whole, what should the margin trajectory be?
Well, one of the things that we made a decision on in the first quarter is to protect the capacity to deliver the order book that we worked hard to build for ourselves. So that's had an impact on margins tactically, but we certainly expect as growth flows through that margins will improve as well. So again, we're confident that we've interjected discipline and operational rigor into how we're running the business. And we are very, very confident that we will trend towards 18% this year, and our North Star is 20%, and certainly as we look to build momentum this year, that will be the plan that we will look to affect over the next couple of years.
Okay, 18% this year, and North Star is 20%. Warren, you said that EU is looking better as compared to the US market, which has been hit by tariffs, etc., just over the weekend. And that's how fast-changing this is. I mean, the US is threatening 30% tariffs on EU. I mean, so suddenly in the last 3-4 days, I'm sure CEOs, etc., would be taking note. And it kind of sort of, again, disrupts things. 30% is significantly higher if it goes through than what many were assuming earlier. So, how confident are you that what you say now will kind of sort of, hold as you go forward? Because many of these things are not business related per se.
Yeah. I think our confidence is informed by the engagement and the discussions that we're having with our customers. Clearly the threat of 30% and with some jurisdictions higher tariffs, I think that's not helpful. But I think there is confidence that common sense will prevail. That there is a view that some of these threats are negotiating tactics, and again, our customers are increasingly confident that the uncertainty that prevails at the moment will be short term. And I think if that can be realized, we're in a very good position to really kick on from where we are at the moment. Our business is exclusively focused on the manufacturing sector. The manufacturing sector, and specifically the automotive industry, is product driven. And I think over the last 12 months, given the election uncertainty in the US, given the runoff of incentives in the EU, a lot of our customers have stalled investment in new product, and so there's a lot of latent demand that is out there. And again, we are very, very confident we're going to be able to intersect with that.
Mr. Harris, just sort of to understand this, you mentioned that you're confident of retaining full-year margins at around 18%, with 20% being the North Star. So the 200 basis points dip in margins that we saw in the first quarter, was it entirely because of certain deal ramp-ups not happening, certain delays? And I'm just trying to understand if there's any change in pricing. And also just let us know what your thoughts are on wage hikes, because a lot of the larger IT services companies, they've not yet committed to wage hikes. What about you?
Well, let me just qualify that I expect to get back to a run rate of 18% as we progress towards the end of the year. Whether or not we'll be able at a consolidated full year level to get back to 18% will very much depend upon how the next three months goes. But we are very, very confident that the headwinds that we are grappling with at the moment are short term and are driven by the macroeconomic uncertainty. You know, as far as wage hikes are concerned, we've not yet made a decision. We will be evaluating over the next couple of months what it is that we will need to do, and we'll make a decision likely in the September timeframe in terms of what will be appropriate for us to reward the teams that are working diligently to deliver value to our customers.
So basically, by the end of this year, you're hoping that margins will be at 18%, though on a full year basis, FY26, you know, we'll have to see, right?
But we will have to see. You know, our commitment and the business plan that we're working to is margin preservation. But I'm certainly very, very confident that by the end of the year, we will be back to a run rate that will be consistent with what we've delivered over the last 3 years.
Well, good luck to you with those plans, and good luck to your team as well. Thank you very much for joining in and giving us some perspective on the business. Well, that's Tata Technologies sounding quite confident for the rest of the year, though the first quarter has been a bit of a bumpy start for them. Well, let's get you an important programming alert. The governor of the RBI will shortly be speaking with CNBC-TV18's Lata Venkatesh. Expect answers for all the questions that are bothering you. Does 6-year low inflation open up space for more rate cuts? Does low CPI give RBI scope to keep liquidity surplus for longer? Will tariff wars force down RBI's GDP growth forecast? Well, tune in afternoon for the most definitive RBI governor interview only on CNBC-TV18. Right, with that, it's time for a special segment, Quarter Se Quarter Tak, where we bring you earnings expectations from one sector every day. And the sector in the spotlight today is the metal space. Nigel is going to join us and tell us just how Q1 might be for a lot of the metal majors. Nigel.
Well, let's begin with the ferrous space first up, where steel companies are expected to deliver a strong performance in the first quarter. The steel EBITDA is projected to rise between 4 to around 15% on a quarter-to-quarter basis. That's thanks to two factors. One is a rise in domestic steel prices by roughly around 2,000 to 2,500 rupees per ton, and a decline in coking coal costs by around $10 to around $12 per ton. However, this margin improvement is expected to be partially offset by higher iron ore cost as well as lower sales volumes. The volumes could decline by around 3 to around 17% quarter-on-quarter, mainly due to the planned maintenance shutdowns and muted export demand. And also the early arrival of monsoons, well, that's going to be a bit of a dampener on the volumes front. On a company-specific basis, all companies will report an improvement on the EBITDA per ton. Tata Steel India, well, the EBITDA per ton is expected around 14,500 rupees per ton, while Europe is expected to trim its losses to around a negative $28 per ton. That's down from close to around $40 per ton in the previous quarter. JSPL as well will report a solid gain. The EBITDA per ton is expected to jump up to around the 13,850 rupees odd, while JSW Steel will clock an EBITDA per ton of around 10,820 rupees per ton. SAIL, well, that'll see a modest improvement. The EBITDA per ton will move closer to around that 8,000 rupees odd mark. Jindal Stainless from the stainless pack, well, that'll report a good bounce back. Remember, quarter 4 was quite soft. This time around, there'll be a 10% quarter-on-quarter growth in the consolidated EBITDA per ton and could come in the vicinity of around 18,200. Two factors support them. One is realizations, which are higher, and the cost of production, which will be relatively lower. Moving to the non-ferrous side of things then, quarter 1 is expected to be soft. That's because of the decline that we've seen in commodity prices. The average LME prices for aluminium as well as zinc, they are down by close to around 7% on a sequential basis. That's what could weigh on the profitability as well as on the top line. However, silver has bucked the trend. It's up close to around 5 to 6% odd. It's hit its highest levels we've seen in more than 10 years. Coal India, though, they're expected to report a 20% drop in the EBITDA. That's because of lower volumes and pricing. You have also seen the e-auction prices that are lower. The cost of production for them has moved up as well, so that's what will hurt Coal India. NMDC could see a 5% growth in the EBITDA. That's because of the higher volumes, which will jump up by mid-teens, though the benefits will be limited due to higher cost of production and lower realization per ton. Hindalco's India business, well, that'll get hit because of aluminium prices, which are down. And also we have seen that, the cost of production as well could get a hit a little bit. While Novelis, its overseas subsidiary, that will see a 9% quarter-on-quarter drop on the EBITDA per ton, should come in at roughly around $450 on a per ton basis because their operations have been impacted by tariffs on Canadian imports into the United States, rising input cost as well. Vedanta, well, on a consolidated EBITDA basis, there'll be a decline out there because of aluminium and zinc prices. Both of them are down by close to around 7%. However, gains from lower alumina cost and increased captive sourcing, that's what will help partially offset some part of that impact. To sum it up, metals sector in Q1 FY26 is expected to be a tale of two halves. Steel companies are poised to report strong earnings momentum supported by rising prices, falling coal cost, while non-ferrous players, they'll face profitability pressure owing to the drop in commodity prices. Let's wind this down with the valuation snapshot that we have up for you on the screen. Well, let's welcome Ravi Sood, the research analyst at Elara, who joins in on the show. Hi, Ravi. Thanks a lot for joining in. It's been a while since we had you on the show. Give us, the outliers for the sector. In the ferrous pack, which company are you expecting to report very, very strong numbers? And what is your top pick? So let's get the ferrous section first out of the way.
Yeah, good morning. So basically, on the steel front, barring JSW and SAIL, rest of the companies should report a negative volume growth. For JSW, the recovery in EBITDA should be sharper because of combination of higher volume on account of the new blast furnace as well as steel pricing. Apart from this, in steel Europe, we should see a sequential basis driven by lower losses in UK.
Right. Ravi, got a little bit of a connection issue, I think so. I just want to get a couple of numbers out of the way. For Tata Steel Europe, the EBITDA per ton loss is expected to come down, and Nuvama estimates said that it will come down by close to around $10 per ton. What are you factoring in terms of an improvement, and when do they break even?
So break even is expected in the second half. In terms of EBITDA per ton, overall Europe, so roughly about negative $32. We are expecting it to be closer to $35-36 this quarter.
Okay, got it. All right. And from the non-ferrous pack, do you think the street will look through the weakness that we've seen in prices? What is your view on a stock like Hindalco? Because Novelis yet again will get impacted, but the street is bracing for this impact, right, because of the tariffs. So $450 per ton is what some analysts are working with. What about you?
So yeah, basically there should be a hit of the tariffs, which should result into a fall in EBITDA per ton for Novelis from about 495 to closer to about $445 to $450. But what is important to look at is the fact that Q2 we should see a recovery in profits driven by improvement in energy prices that we have seen, and taking into account the demand supply situation, the sustainability of aluminum prices or the relatively higher is more likely.
Okay. All right. Ravi, appreciate you joining in. Thanks a lot for giving us all of those details. We'll touch base as the course of the metal numbers do start coming in. Short point is steel will shine brighter, while the non-ferrous pack could see some pressure because of the pressure that we've seen on LME prices. Though silver will twinkle a little bit more than the other commodities that we've seen. Well, time to slip in a short break, but after the break, we'll be joined by Bhavesh Agarwal of Ola Electric Mobility to discuss the past quarter's numbers and the ambitious guidance that they've given as well.
Welcome back. Now, Ola Electric is the next management, as we just said, coming up on the program. Earnings came in. and they've improved sequentially. The market gave a big thumbs up yesterday. Gross margins are up about 1,100 basis points. Bhavish Agarwal is Chairman and Managing Director at Ola Electric Mobility. He's with us now. Bhavish, good morning. Great to have you with us here on the program as always. Prashant here. So earnings have improved, as I said, quarter on quarter, but of course from a very low base, Bhavish. You are projecting for the, auto EBITDA to turn positive, the business itself to generate operating cash flow in FY26, positive cash flow by FY26, etc. But before the financials, because the financials is the end product, the product is the first story, right? Do you believe, Bhavish, as we speak today, a lot of the product-related issues, especially on the after-sales, etc., those issues have been fixed? Because unless those are fixed, the derivative of that is financials and earnings and everything else is downstream. So just wanted to start with that, Bhavish.
Sure, Prashant. First, actually, I'll just highlight 2 or 3 key things from our earnings. Our auto business achieved the EBITDA guidance we had given for Q1. And more importantly, actually, in June, we were EBITDA positive. So in that sense, probably a very important milestone for the company to be EBITDA positive for the first time ever in our journey. A second highlight was also cash flows. Our operating cash flows also came in almost neutral at a negative 27 crores for the whole quarter. And both the profitability and cash flows has gotten to this level because of new product introductions by us over the last 3 months. Specifically, our Gen 3 scooters have done really well in the market. Almost 80% of our vehicles sold are Gen 3 products now. Consumers, and even though Gen 3 is priced slightly higher than Gen 2, consumers are really preferring our Gen 3 product. Our bike has seen very good early traction, very good interest from everybody. We are releasing the bikes into stores in a calibrated manner. So bikes are available in 200 stores now and scaling up through this quarter. By the time festive comes in, Navratri comes in, we will be across most of our stores. So some of the product comments that you shared, the service issues which were there in Q3 of last year have since largely been dealt with. Most of the service challenges that we had have been fully resolved. It was not really product linked. As I had shared, then it was network linked. Our network scale had to go up to service the extra volumes that we had sold in the last 3-4 years. And just to underline and remind everyone that we've sold almost 1 million vehicles, which is still almost 2x of our nearest competitor. So in that sense, the vehicles on road for us is much higher than our peers.
So, Bhavish, I'm morning. That answers Prashant's issue on product-related concerns. The next step is getting the products to the market, right? And here, at least over the last couple of days, the headlines out of Maharashtra seem, again, pretty confusing. Reports are indicating that 90% of the Ola stores will have to be shut down because there's an issue with licenses and permits, etc. Can you just set the record straight on this and how you're engaged with the state government? Because Maharashtra is a big state when it comes to EV sales.
Any state is important for us, Surbhi. We are, again, about a couple of quarters ago or about 4-5 months ago, we had acknowledged this issue that we had opened all these stores and some local level licensing and local level certification had to be done. And we have since then been doing it. A lot of ground has been covered across all states. Maharashtra is a slightly more nuanced state in terms of the level of local documentation, etc. required, but we are covering that ground. And we are continuing to engage with the state government and covering that ground. There's been no official communication to us of this, so maybe it's more speculative. But from our side, we've been very diligently just covering all the ground on local regulations to make sure all our stores are compliant on any local regulations across the country, not just Maharashtra.
But could it impact your second quarter sales? You're saying you've officially not received any notification from the government. You have 450 stores in the state, right?
Thereabouts, yes.
And the state government has not communicated its intent to seal the stores or shutter the stores?
See, like I said, we are going through the process of getting the local regulations. And in that process, there will be a certain set of engagements with the different authorities, state level or even local level. And we are getting through that whole process. In terms of our sales impact, a lot of our sales actually are done online. So they're not really dependent on the store. And even when we have all these large number of stores, they're largely used as places where customers come and pick up their vehicles, because the sale happens online. A sale happens even, unlike traditional dealerships, we don't really stock inventory in our stores.
So should investors affect any impact on Q2 sales because of this or not?
No, the impact should be very minimal, if at all.
All right. Hi, Bhavesh. Good to see you. And as always, as a bike lover, you're always looking at new bikes, right? And you've entered the bike market and you're sounding very optimistic out there. Now, you've given this guidance of around 325,000 to around 375,000 or thereabouts. How much of it will come in for bikes and what's the traction you're seeing on ground?
Nigel, bikes are getting a lot of positive response on social media, in our customers, in our community. It's a great product. I myself have been riding the bike around Bangalore all day, all through the last few months, actually. And the product, like I said, we are in a calibrated way ramping it up across different stores. It's a new category for us. It's a new category for the EV industry at scale. So we want to make sure the new product establishes itself well in a phased manner. So that's our focus. Response has been very, very strong, and we feel very confident about the product doing well.
So bikes will be what? Mid-teens as a contribution of the total volumes?
For the whole year, maybe slightly higher.
Slightly higher. 15 to 20% is a gettable number?
Yes, that's what we would expect, yes.
All right. Since you spoke about the feedback and social media, service turnaround time, that's in check. We keep getting these responses to some of our earlier interviews as well that ask Bhavesh, are the customers being, taken care of in the after service? Are things better?
The things on service have improved a lot from Q3. We're continuing to focus on improving and institutionalizing our operations in the front end. I mentioned in my note also in the shareholders letter that one key area of management focus will continue to be our entire front end, which includes sales, service, fulfillment times, etc., getting more stores live for our bikes and for our Gen 3 products. So that's a very core management focus for this quarter.
So service turnaround time is 1 day?
The service turnaround times are industry standard for us also. Whatever the EV industry runs at, we will be running at the same times. We want to do better than that. So a lot of initiatives underway, to do better than that.
Bhavesh, and it'll start to show word of mouth, and you need that tide to turn, right? Because at the end of the day, it's a consumer product. People can touch and feel, and they drive and they have an experience, and that'll be organic. But you need to, in terms of sales volume, etc., have to turn that around a little bit. I mean, if you're saying that the service, etc., is now much better, it's in line with industry average, etc. I mean, people need to know about it,
Prashant, our customers know about it. We are one brand which hardly advertises, and yet people buy our products in very high volumes. And Q1 over Q4 has also increased in volume. So I think the numbers speak for themselves. And on the ground, in the community, the sentiment is generally positive.
What about discounting, Bhavesh? I mean, we saw, a spate of discounting over the last many quarters for some of the products. Have we, in a way, hit a bottom there and things have stabilized? Can you give us some perspective, context, really?
So, Prashant, instead of that, I will actually give you our gross margins. So, if you look at our gross margins in Q1, they were 26%. And this quarter was without any meaningful PLI benefit. So even without PLI, our gross margins are 24%. And this is industry leading by far. So discounting or no discounting, our business in unit economics does really well. And that's actually in June, the company turned, the auto segment turned EBITDA positive because gross margins, two reasons. Gross margins came in very good. And that's a function of our new products, Gen 3 and bike starting to scale. And second is our OPEX reduction program has also delivered on the targets we promised the street.
On the auto side, Bhavesh, EBITDA margins, you're looking at what, 5% or so?
For the whole year. Yeah.
For the whole year?
For the whole year. This quarter should be in the positive territory.
Yeah, and so the auto segment, your EBITDA positive. Now, Bhavesh, at the blended company EBITDA level, and as well as the blended, the net profit level, where there's still a loss. The loss is reduced, but it's still about 428 crores. Can you give us some timelines? When do you turn profitable? First at the overall EBITDA level, and then eventually at the PAT level?
Surbhi, we've given a fairly detailed outlook in our shareholders letter this time. So for our auto business, we said that this full year should be EBITDA positive. Q2 itself will be a EBITDA positive. Even cash flows by the end of the year, our auto segment will be making both operating cash flow and free cash flow. There is still some investment to be done in the cell business to get to the 5 gigawatt hour capacity. So we are allocating capital this year for that capex. Now, beyond that, the auto business profitability should balance out whatever investment needed in the cell business, because the auto business is where the real volume is. So sometime next year, I don't want to give a very hard number there right now, but we'll keep sharing more specific granular updates quarter on quarter.
All right.
So FY27, you will be overall EBITDA positive.
I'm not sharing a number there, but I think if anybody reads the shareholders letter, you'll get a very good feel for it.
Bhavesh, very quickly, before we let you go, any queries coming from SEBI? Are you all, there were various allegations, source-based information that we heard as well. Have you been engaging with them? Have you heard anything? Is there something that your shareholders need to worry about?
The confusion that happened was the registration and registration numbers mismatch in February or March. And I think in our Q4 results, we actually clarified that with a proper walk of how the numbers stacked up. I think in the public domain, definitely this issue has been now behind us. SEBI and we had many conversations, and whatever questions they asked, we definitely clarified.
So nothing for shareholders to worry then?
No.
Okay, all right. Bhavesh, sounding extremely confident about the path ahead. Your shareholders will be waiting by for the turn of events and things to continue in the upward trajectory. Personally, I'm going to try one of those bikes. You've been riding around in Bangalore. Hopefully, I get a ride here in Mumbai. I'll give you feedback the next time you join in on the show. All the best.
Thanks, Nigel. See you.
Some new innovations, and we look forward to try some of that.
Okay, all right. So catch Nigel on that electric bike.
Looking for something more. Dil mange more. Let's try it. Bhavesh is riding it. Might as well.
So the Tesla model first or Ola bike
Tesla
first?
I've done actually.
He's going for the drive. Mayor is driving him, remember? All around the city.
Maybe ride the Ola bike to the Tesla showroom.
To the Tesla showroom.
No, Tesla I've already done actually. I've driven it
in the US.
In the US.
On Bombay roads. That's the real test.
No, and that's not achievable. Tesla I cannot buy. But at the Ola, maybe, it could be a possibility because I love two-wheelers.
Well, Nigel, wait for the 70% import duty to. I'm sure it won't be 70%. It will be brought lower.
No four-wheeler, two-wheelers.
For two-wheelers. All right. Well, I think just a quick programming note on that point. So this is a big CNBC-TV18 exclusive which is coming up. The RBI governor will be speaking with Lata Venkatesh. All the questions with regards to growth, regulation, what ahead. Remember, inflation is at a 6-year low. Liquidity, of course, has now been pumped up. Global risks. What does it all mean for rates and growth? That's the most definitive RBI governor interview. Post-noon today only here on CNBC-TV18. Okay, well, I think you got 30-odd points on the Nifty. We've got 25,100 as far as the indexes are concerned. Mitesh is with us, back with us with what he wants you to do. Mitesh, good morning. What do you have? Trades?
Good morning, Prashant. So the banking index and the banking stocks are looking good. I have a buy on Bandhan Bank. Keep a stop below levels of 177. Look for a target of 190 to begin with. Maybe eventually even higher, but for timing 190. And a sell on HCL Tech with a stop at 1570 for targets of 1510.
Okay, all right. Got that, Mitesh. Thanks very much. So that's the trading advice now. At just about 10 o'clock, we'll take a break, come back on the other side, and Manisha Gupta will join in with all the commodity market action. Welcome back. So the equity market is having a steady morning, still about 40 points up on the Nifty. Let's find out what are the big headlines in the commodity space. Manisha is back with us. Manisha, so what's top of mind for you?
Well, I'm looking at the crude oil prices because there are just so many statements going on. By the way, the Chinese data, most of that has come into the markets has beat street expectations. It is better than and it is less slower in sense of pace when it comes to the markets there. And that clearly could be a supportive factor there. But what really has led to some profit taking in crude, and it fell nearly 2% in the overnight markets, has been that US has given Russia a 50-day deadline to agree to a ceasefire. Now, this is the markets were anticipating that you could be looking at sanctions, restrictions, some big bang announcement from US yesterday itself, but we did not see that coming. Now, this has been postponed, and US has warned Russia of further sanctions of up to 100%, but this is a warning. And knowing US, we've seen a lot of rhetoric go on and not so much on ground. So the markets do believe that this perhaps could be sorted or solved in some sense. Now, buyers for Russia are countries like China, India, and Turkey. And while US has said that the sanctions would not only be on Russia, but on the third party, that is on the buyer secondary market as well. And that is where the concern really comes in from. When you look at the month of June, the Russian oil exports have been at the tune of 9 million tons. Now, that is a big amount. Russia, I'll remember, is the second largest producer when it comes to OPEC and allies there. And even, and it's not just about US, European Union also has said that they could be announcing an 18th package of sanctions against Russia. This could come in as early as this week itself. Now, OPEC's spare capacity is something that we keep talking about, that there's going to be more surplus going forward. And that has been keeping the crude oil prices in check. But if there are 100% sanctions on Russia and an 18th package from European Union as well, then that spare capacity that we seem to be relying so strongly right now is not going to be sufficient to fill in a gap of 9 to 10 million barrels per day. Now, the US higher tariffs for partners also is a bit of a concern. You could be looking at economies not doing so well, demand growth not so strong, and that in turn also seems to be weighing on in sense of crude oil prices there. Now, this is what Goldman Sachs has come out with in sense of its targets for this year. They're anticipating $66 a barrel for the second half, and they expect the prices to continue to decline in 2026 as well. From 66 to 56 is what they believe could be an average in the next year. But starting 2027, they believe that the crude prices will be higher. Because of these lower prices, you wouldn't see investments. Demand is expected to be stronger. So this year and the next year, it is going to be between 50s, 60s, max 70 that you could be looking at in sense of crude prices. Lack of new OPEC projects, lack of investments in the space are supportive factors going forward. But that's only expected in 2027. In the meanwhile, the European Union also has intensified its conversations with other trading partners like Canada and Japan and are looking at a collated response to US tariffs there. And then the markets also are looking at loads of US data that is coming in today. You have the inflation numbers, CPI and PPI numbers, all of that in this week itself. And then it also is about the industrial production, manufacturing activity, retail sales. All of that US data comes in this week.
All right. Thanks very much, Manisha, for that. That's commodities in focus as always. Let's focus on HCL Tech. Some more detail here. Reema's going to tell us what the street made in the numbers. Reema, take it away.
Thanks so much for that. So let me quickly outline a couple of reasons why the stock is under pressure today. Reason number one is the margin miss in Q1. EBIT margins declined by 160 basis points on a quarter-on-quarter basis, 16.3%, much lower than consensus. This led to a drop. This led to the company lowering the margin guidance by 100 basis points. And now the new margin guidance stands at 16 to 18%. Two, some of the brokerages have downgraded their assessment of HCL Tech. So JP Morgan downgrades HCL Tech to a neutral. They say AI deflation is playing out via margin erosion. Nuvama too has downgraded the stock and cut the target price to 1630. Ambit also echoes in a way what JPM says. The results corroborate our view that margins will be the next casualty after growth. Also, the third reason is HCL Tech outperforms some of its larger peers. So in the last 1 year, HCL Tech was the only one with flat, no return or no contraction in share price, but its peers had underperformed. In the 5-year, HCL Tech share price has gone up by nearly 150%. That said, there are many brokerages who still are upbeat on HCL Tech. So Nomura maintains a buy, and they say the street should ignore the near-term margin miss because the management themselves is saying that margins will revert, come back to the original levels in FY27. And focus should be on revenue outperformance, growth outperformance, which HCL Tech is doing. Jefferies too. Jefferies, in fact, has upgraded HCL Tech today. Back to you.
All right. Thank you very much, Reema, for that. Well, time to quickly take a break. On the other side, our special segment is the economy. My colleague Lata discusses the ultra-low June CPI and the possibility of more rate cuts with Aurodeep Nandi of Nomura, Abhishek Bisen of Kotak AMC. Coming up.